All markets are increasingly at risk. Pick your asset class. They all look pretty rich. Do you agree with any of that?
You know, I think the richest asset is cash, honestly. And I think to the idea that there's a lot of risk out there, I mean, we're at the end of a multi-decade buildup in debt on the private sector and then the government side. And if you ask me, what's the preferred asset class in an environment where there's a lot of debt outstanding, it's probably bonds. I think what people aren't realizing is that inflation is running pretty close to target. And so that means in the United States, and although the inflation rates are lower abroad, the shape of the yield curve is the same. The cash is burning, right, relative to inflation. So, you know, we've had a good rally in treasuries here. There's room for consolidation. But I think that you're in an environment that's still a ways off from the next recession, probably a ways off from the next crisis, and people are still probably supposed to be extending on the yield curve, extending into the credit sectors, and probably still in the stock market.
10-year Treasury is just south of 220, 5-year average 216. When you hear a lot of people talk, it's as if these levels are kind of abnormal, but they've become quite normal, haven't they? Yeah,
and you know, in your last set, there was the discussion of the inflation rates are gonna go up. And maybe they will, but it strikes me this is a world with a lot of excess supply. And people are still waiting for inflation to catch on, for wages to catch on. But globalization is a pretty powerful force in terms of downward pressures. And I think these central banks, they don't mean to, but they are really acting as if their inflation targets are a ceiling in terms of their behavior. And we'll see that today with the Fed.
Well, what do you expect from the Fed? I mean, what is the risk of the Fed overreacting?
So I think they're really trying to sneak in these hikes. That's probably what half of those participants are thinking, so that in the next recession you can simply cut rates. But the idea that what's in the dot plot, 140 at the end of this year, 210, 3%, that you're going to execute those hikes, get to a neutral level without slowing down an economy that's really not growing at that impressive a rate, is maybe already slowing down. I think it really doesn't make sense. So I think you're going to get the rate hikes from them. I think they'll be cautious. Our big risk is going to be next year when we see who's at the Fed.